Welcome to Books and More, the channel where knowledge meets inspiration. Here, we bring you the world's most powerful books, summarized, narrated, and transformed into engaging audio stories designed to enlighten your mind and elevate your life. In today's episode, we explore The Warren Buffett Way, a timeless guide to the principles, discipline, and mindset behind the world's greatest investor. Through his journey, you'll discover how patience, reason, and integrity can turn simple ideas into lasting success. Sit back, listen, and let the wisdom of Warren Buffett inspire your own path to greatness. Chapter 1: The World's Greatest Investor. Warren Buffett stands as the most extraordinary investor of our time, not because of mere numbers or wealth, but because of the consistency, clarity, and humanity behind his success. His journey began in Omaha, Nebraska, where he was born in 1930 to a stockbroker father and a family that valued both work and intellect. Even as a child, Buffett showed an unusual fascination with numbers, money, and business. He read his father's books on the stock market at 8 years old and ran small enterprises before most children learned multiplication. Though he wanted to skip college to start working, his father insisted on formal education, a decision that led Buffett to the University of Nebraska and later to Columbia Business School, where he met the man who would change his life, Benjamin Graham, the father of value investing. Under Graham's mentorship, Buffett learned to see stocks not as paper certificates, but as pieces of real businesses. After earning his master's degree, he worked for Graham-Newman Corporation, where he absorbed the principles of intrinsic value and margin of safety that would later define his own philosophy. When Graham retired in 1956, Buffett returned to Omaha and started his own investment partnership with 7 limited partners and a total capital of $105,000, only 100 of which was his own. Yet what began as a small venture soon became a phenomenon. Buffett managed to compound money at an astonishing rate of nearly 30% annually for 13 consecutive years, outperforming the Dow Jones by more than 20 percentage points each year. He achieved this not through speculation or luck, but through patience, discipline, and a deep understanding of human behavior in markets. Buffett's genius was not in finding secrets, but in applying simple logic with iron discipline. He bought undervalued companies, ignored market noise, and allowed compounding to work its magic. His purchase of American Express during a crisis in 1963 exemplified this courage. When the company's reputation was temporarily damaged, its shares fell sharply. Buffett recognized that its core business remained strong, and he invested 40% of his partnership's assets into the stock. Within 2 years, the price tripled. This was a defining moment, the practical application of Graham's lessons and the birth of Buffett's unique style, buying quality businesses at fair prices and holding them patiently. By 1969, Buffett felt the market had become too speculative and decided to close his partnership. Investors received their shares of the profits, and many followed him into Berkshire Hathaway, the struggling textile company he had begun buying earlier. Over time, Berkshire became the vehicle for Buffett's investment empire. From its humble beginnings with a net worth of $22 million, Berkshire grew under his leadership to over $69 billion, with an annual growth in book value of more than 22%, a record unmatched in financial history. His long-term approach, combined with moral clarity and rational thinking, turned Berkshire Hathaway into one of the most admired companies in the world. Beyond numbers, Buffett's character shines through his simplicity and candor. He writes Berkshire's annual reports in plain English, treating shareholders as partners and explaining both successes and failures with honesty. He avoids unnecessary complexity, focusing instead on logic, integrity, and long-term value. His offhand humor and self-awareness make him approachable, but beneath the humor lies an uncompromising rational mind. To Buffett, investing is not about predicting markets, it is about understanding businesses, recognizing value, and maintaining emotional discipline. He sees the market as a voting machine in the short term, but a weighing machine in the long run. Even as Berkshire's size made extraordinary returns harder to achieve, Buffett's philosophy remained unchanged. He continued to buy predictable businesses at rational prices and refused to invest in companies he did not understand. His method proves that great investing is not about brilliance, but about temperament, the ability to stay calm when others panic. Warren Buffett's story, therefore, is not merely about building wealth, it is about mastering oneself. His way, rooted in patience, simplicity, and unwavering principle, remains the truest guide for anyone seeking enduring success in the world of investing. Chapter 2: The Education of Warren Buffett. The Education of Warren Buffett is the story of how a brilliant but humble man transformed simple ideas about value, discipline, and human behavior into a lifelong philosophy of investing. While Buffett's approach is unique, it is deeply rooted in the teachings of four great thinkers who shaped his intellectual foundation: Benjamin Graham, Philip Fisher, John Burr Williams, and Charlie Munger. Each contributed a distinct element. Graham taught him the importance of buying undervalued companies with a margin of safety. Fisher emphasized the qualitative side of business and management. Williams provided the theoretical backbone through the concept of intrinsic value, and Munger encouraged Buffett to broaden his thinking beyond numbers and embrace the psychology of decision-making. Together, these influences created the framework that defines Buffett's investment genius. Benjamin Graham was Buffett's most profound mentor and the father of value investing. Graham believed that investing should be treated as a rational business enterprise, not as speculation driven by emotion. His famous definition of an investment, one that promises safety of principal and an adequate return, became Buffett's moral compass. Graham taught that investors should view stocks as pieces of real businesses, not as symbols on a ticker tape. He introduced the powerful idea of the margin of safety, which means buying securities well below their intrinsic value to protect against uncertainty and error. This principle, simple yet revolutionary, appealed to Buffett's mathematical mind and his desire for logical structure. Under Graham's guidance at Columbia and later at the Graham-Newman Corporation, Buffett learned to identify undervalued companies, often those ignored or abandoned by the market, and to profit when reality eventually corrected the market's misjudgment. But Graham's purely quantitative approach, focusing heavily on balance sheets, ratios, and liquidation values, had its limits. It treated businesses as numbers, not as living, evolving entities. This is where Philip Fisher's influence reshaped Buffett's thinking. Fisher, author of Common Stocks and Uncommon Profits, believed that the greatest fortunes come not from buying cheap stocks, but from owning outstanding companies with strong management and long-term growth prospects. He advised investors to study a company's people, products, and culture before investing. His famous scuttlebutt technique, gathering insights from employees, customers, and competitors, helped investors see the true potential of a business beyond its financial statements. From Fisher, Buffett learned that a great business purchased at a fair price can be far superior to a mediocre one bought cheaply. This shift, from focusing on price to focusing on quality, marked a turning point in Buffett's evolution. John Burr Williams, though not a personal mentor, contributed the intellectual bridge between Graham's realism and Fisher's vision. In The Theory of Investment Value, Williams introduced the concept that the true worth of any business is the present value of its future cash flows. This idea of intrinsic value became the core of Buffett's valuation model. He learned to estimate a company's future earnings, discount them back to the present, and compare that value to the market price. If the market price was significantly lower, the opportunity was clear. Williams gave Buffett the mathematical justification for his intuition, the framework to balance logic and expectation in the valuation process. The final and most enduring influence came from Charlie Munger, Buffett's longtime business partner and intellectual counterpart. Munger encouraged Buffett to move beyond Graham's narrow approach of buying statistically cheap stocks and instead focus on buying wonderful businesses at fair prices. He introduced Buffett to multidisciplinary thinking, the blending of economics, psychology, history, and ethics into investing. From Munger, Buffett learned that understanding human behavior is as critical as understanding balance sheets. Markets are moved by emotion as much as by information, and the best investors are those who can stay rational when others are not. Through these influences, Buffett's philosophy matured into something both scientific and deeply human. He embraced Graham's discipline, Fisher's vision, Williams' logic, and Munger's wisdom. He learned that investing is not about predicting markets, but about understanding value, recognizing quality, and exercising patience. It is about avoiding emotion and anchoring every decision in reason. In the end, Buffett's education was not just about learning to make money. It was about learning how to think clearly, act decisively, and remain steadfast in a world ruled by fear and greed. This blend of intellect, integrity, and temperament became the foundation of the Warren Buffett Way and continues to inspire investors around the world.
Chapter 3. Our main business is insurance, the early days of Berkshire Hathaway. When Warren Buffett first acquired Berkshire Hathaway in the mid-1960s, it was far from the global conglomerate we know today. It was, in fact, a struggling textile mill in New England, battered by foreign competition, outdated machinery, and declining industry. Yet, behind this seemingly unremarkable company, Buffett saw a structure that could serve as a foundation for something much greater. What began as a failing textile operation soon became the cornerstone of his investment empire. In this chapter, we see how Buffett transformed Berkshire Hathaway into a powerful financial engine by using its insurance operations to fuel his long-term investment vision. At the time of Buffett's purchase, the textile business was already in decline. He initially tried to keep it alive, driven by loyalty to its workers and pride in the company's history. But despite his efforts, the economics of textiles offered little promise. The margins were razor-thin, and the capital requirements were relentless. Gradually, Buffett recognized a crucial truth. It was better to invest in great businesses than to rescue poor ones. The decision to move Berkshire away from manufacturing toward a holding company model marked the first major evolution in Buffett's career. It reflected his willingness to admit mistakes and redirect capital toward opportunities with better long-term economics. The true turning point came when Buffett discovered the power of insurance. Insurance, as Buffett understood it, was not just a business of selling policies, it was a business that generated float. Float is the money collected from policyholders that has not yet been paid out in claims. As long as those funds remain with the insurer, they can be invested. If managed wisely, float becomes a source of nearly cost-free capital. Buffett realized that if he could acquire insurance companies with disciplined underwriting and invest the float intelligently, he would have a permanent advantage. This insight would become one of the defining features of Berkshire Hathaway's success. In 1967, Buffett made his first major insurance acquisition, National Indemnity Company, a small Omaha-based insurer known for conservative management. He paid $8.6 million for a company that held more than $19 million in float. For Buffett, this was not merely an insurance deal. It was a financial revolution. The purchase gave him control over investable funds that did not belong to him, but that he could use as long as claims were paid responsibly. The combination of disciplined underwriting and rational investing created a compounding machine that would eventually finance Berkshire's most profitable ventures. Over the next few years, Buffett continued to expand Berkshire's insurance holdings. He acquired home and automobile insurance company and later launched reinsurance operations under the Berkshire name. But perhaps his most significant acquisition came in 1970, when he bought a controlling interest in Geico, the government employees' insurance company. Buffett had first learned about Geico in 1951 when he visited its headquarters as a young graduate student. He was captivated by its business model, selling auto insurance directly to customers, bypassing agents, and maintaining low costs. When Geico later fell into financial trouble, Buffett saw the chance to act on his long-held admiration. His investment not only saved the company, but also provided Berkshire with one of its most enduring profit engines. Through insurance, Buffett had found the perfect business model for his philosophy. Unlike manufacturing, insurance required relatively little capital investment. Its products were intangible, and its raw material, money, could be put to work earning more money. The secret was in managing risk prudently. As Buffett often said, the key to successful insurance is not in predicting hurricanes or accidents, but in ensuring that premiums always exceed claims over time. The profits from sound underwriting, combined with investment income from float, allowed Berkshire to grow exponentially without relying on outside capital or debt. By the mid-1970s, the transformation of Berkshire Hathaway was well underway. The textile operations still existed, but were no longer central to the company's future. Instead, Berkshire had become a financial fortress built on the foundation of insurance. Buffett's ability to see beyond the short-term troubles of an old-world business and into the structural advantages of the insurance model demonstrated his rare combination of patience, imagination, and practicality. He understood that real wealth creation comes from controlling capital and allocating it wisely, not from chasing the latest industry trend. "Our main business is insurance," Buffett declared, summarizing the strategic pivot that defined the next half-century of Berkshire Hathaway's growth. Through this business, he could continuously generate funds to invest in outstanding companies like Coca-Cola, American Express, and the Washington Post, without ever having to sell stock or borrow heavily. What began as a fading textile company became one of the most admired corporations in history, driven by a simple but profound insight. When you control capital that costs you nothing and invest it with discipline, the possibilities are limitless.
Chapter 4. Buying a Business. Warren Buffett's philosophy of investing is rooted in one essential idea. When you buy a stock, you are not purchasing a piece of paper. You are buying a piece of a real business. This simple yet powerful mindset lies at the heart of Buffett's extraordinary success. In this chapter, we explore how Buffett approaches the process of buying a business, the principles that guide his decisions, and the discipline that allows him to ignore the noise of the market in favor of long-term value creation. His goal has never been to predict market trends or chase short-term profits, but to identify businesses with enduring qualities that can compound wealth over decades. Buffett's approach to buying a business evolved from his early education under Benjamin Graham. Graham's method focused on buying stocks that were statistically cheap, companies trading below their net asset value or earning potential. But over time, Buffett realized that not all cheap companies are good investments. Some are cheap for a reason. Their business models are weak, their management uninspired, or their products obsolete. From this realization came one of his most important insights. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. This principle shifted Buffett's focus from short-term bargains to long-term quality. He began to search for companies with durable competitive advantages, those that could protect and grow their profits over time regardless of economic cycles. When Buffett evaluates a potential investment, he treats it as if he were buying the entire company. He asks a series of fundamental questions. Is the business simple and understandable? Does it have consistent earning power? Does it have good returns on equity with little or no debt? Does it have honest and capable management? And finally, is the price right? These questions form the foundation of his investment process. They are not complex formulas, but common-sense tests designed to separate businesses that can survive and thrive from those that are vulnerable to competition or market shifts. A critical part of Buffett's thinking is his insistence on simplicity. He invests only in businesses he can fully understand, those within his circle of competence. This circle defines the boundaries of what he knows and, more importantly, what he does not know. He avoids companies whose future earnings depend on unpredictable factors, such as technological breakthroughs or volatile commodities. Instead, he prefers businesses with stable demand, loyal customers, and predictable cash flows. Coca-Cola, American Express, and Gillette are classic examples. Companies with clear products, powerful brands, and the ability to raise prices without losing customers. To Buffett, such companies are not just investments. They are money-making machines that generate cash year after year. Buffett also emphasizes the importance of management quality when buying a business. He looks for leaders who think like owners, people who are candid with shareholders, conservative with debt, and focused on long-term results rather than quarterly earnings. He famously avoids companies where management chases fads or manipulates earnings to impress Wall Street. Integrity and rationality, he believes, are more valuable than charisma or ambition. Once he finds the right managers, he gives them full autonomy, trusting them to run the business while he allocates capital. This decentralized model has been a hallmark of Berkshire Hathaway's success. Another key factor in Buffett's buying process is the concept of the economic moat. Just as a castle is protected by a moat, a great business must have a durable competitive advantage that shields it from competitors. This moat could come from brand strength, network effects, cost leadership, or regulatory barriers. The wider and deeper the moat, the more secure the company's future profits. Buffett invests only when he is confident that the moat will endure for decades. He avoids industries where competition can quickly erode margins, or where innovation constantly resets the playing field. Finally, Buffett's discipline in price cannot be overstated. Even the best business can be a poor investment if purchased at the wrong price. Buffett calculates a company's intrinsic value, the present value of its future cash flows, and insists on a margin of safety before committing capital. This means buying only when the price is comfortably below the company's true worth, allowing room for error and uncertainty. Patience is essential. Buffett is willing to wait years for the right opportunity, preferring inactivity to mediocrity. As he often says, the stock market is designed to transfer money from the active to the patient. Buying a business for Buffett is both art and science. It requires logic, emotional control, and the ability to see beyond temporary market moods. It is about aligning capital with quality, character, and value. Through decades of experience, Buffett has shown that wealth and investing does not come from constant action or clever predictions, but from a small number of intelligent decisions made with conviction. By focusing on the business itself rather than its stock price, he reminds us that true investment success is achieved not by outsmarting others, by thinking clearly and acting rationally when others do not.
Chapter 5. Investing Guidelines. Business Tenets. At the heart of Warren Buffett's investment philosophy lies a simple question: what makes a business truly great? Before buying any stock, Buffett insists on understanding the underlying business as if he were purchasing the entire company. This mindset is captured in what he calls the business tenets, a set of principles that help him evaluate the economic foundation of any enterprise. These tenets are not about predicting short-term performance or following market trends. They are about identifying enduring qualities that allow a business to generate consistent, long-term value. Through discipline and deep understanding, Buffett developed a framework that separates exceptional companies from ordinary ones. The first business tenet is simplicity and understanding. Buffett refuses to invest in companies he cannot fully comprehend. He calls this staying within his circle of competence. This principle protects him from speculation and emotional decision-making. If a business is too complex or relies on unpredictable technologies, he stays away. Buffett prefers straightforward enterprises with clear products, stable demand, and transparent financials, businesses he can explain in one sentence. Coca-Cola sells beverages people have loved for over a century. Gillette makes razors that men use daily. See's Candies sells chocolates that have loyal customers. Each company is easy to understand, yet their simplicity hides the brilliance of their economic models. Buffett knows that complexity often disguises fragility, while simplicity often endures. The second tenet is a consistent operating history. Buffett seeks companies with a proven track record of success. He avoids startups, turnarounds, or firms with erratic earnings.
He believes that a company's past performance reveals its economic character. Businesses that have weathered recessions, competitive threats, and market changes demonstrate the resilience needed to thrive in the future. For Buffett, consistency is not just about stable profits, it's about demonstrating that management understands its business model and can execute it year after year. When he looks at decades of steady results from companies like American Express or the Washington Post, he sees reliability that numbers alone cannot capture. The third tenet is favorable long-term prospects. Buffett does not chase industries that are merely popular or fast-growing. He seeks those with sustainable competitive advantages, what he calls economic moats. A company with a strong moat can maintain pricing power, customer loyalty, or cost advantages that competitors cannot easily erode. For example, Coca-Cola's brand power and global distribution network make it almost impossible for a newcomer to dethrone it. Similarly, insurance companies within Berkshire Hathaway benefit from low-cost operations and disciplined underwriting, giving them an enduring edge. Buffett knows that real value comes from a company's ability to keep competitors at bay while compounding profits over decades. These business tenets lead Buffett to another fundamental insight. A great business does not require constant reinvention. Instead, it should operate within a predictable environment where its strengths can compound naturally. He avoids industries where technological change or regulation can disrupt even the best-managed firms. That's why he famously avoids investing in most technology companies, not because they are bad businesses, but because their future economics are too uncertain. Buffett's discipline allows him to focus only on what he can know with confidence. He once said, "We don't have to be smart across the board, only within our circle of competence." This humility, paradoxically, gives him a decisive advantage. Buffett also understands that a company's true success comes from durability, not glamour. Many investors are drawn to exciting innovations or short-term growth stories. Buffett, on the other hand, looks for quiet strength, a business that can earn high returns on capital without needing constant reinvestment or expansion. He values steady cash generation over headline-grabbing expansion. This principle explains why he often invests in mundane industries like beverages, insurance, or consumer goods, businesses that satisfy everyday needs and stand the test of time. Underlying these tenets is a deep respect for the relationship between a company's business model and its intrinsic value. Buffett does not rely solely on accounting figures or forecasts. He looks for the qualitative essence of a company's success. He studies how it earns money, how it protects its profits, and how it will continue to do so in the future. This clarity allows him to make decisions with confidence, even when markets fluctuate wildly. To him, the stock market is merely a reflection of human emotion, but the business itself is the anchor of reality. In the end, Buffett's business tenets reveal his rare combination of logic and patience. He knows that extraordinary results come from owning extraordinary businesses, and that finding them requires understanding, not speculation. By insisting on simplicity, consistency, and durable advantages, he turns investing from a gamble into a rational process grounded in common sense. Through these principles, Buffett reminds us that the true art of investing is not in predicting the future, but in recognizing timeless quality and having the discipline to hold it for a lifetime. Chapter 6: Investing Guidelines, Management Tenets. Warren Buffett often says that he invests not only in businesses but in people. Behind every successful company, he believes, stands a leader whose integrity, intelligence, and ability to allocate capital determine the firm's long-term destiny. In this chapter, the focus shifts from the economics of the business to the individuals who guide it, the managers. Buffett's management tenets are a set of principles that help him judge whether those running a company are capable, honest, and truly aligned with shareholders. While many investors analyze financial statements and competitive advantages, Buffett goes further, studying the character and motives of the people who control the money. For him, understanding management is as essential as understanding the business itself. The first management tenet is rationality in capital allocation. Buffett believes that the primary job of a manager is not merely to grow revenue or expand operations, but to allocate capital wisely. Every dollar retained by a company should be reinvested only if it can earn a higher return than shareholders could achieve elsewhere. Managers who blindly chase growth or acquisitions without regard to return on capital destroy shareholder value. Buffett prefers executives who think like owners, who know when to reinvest in their business, when to repurchase shares, and when to return money to shareholders as dividends. Rational capital allocation is not about ego or empire building, it is about discipline and logic. Buffett's admiration for CEOs like Tom Murphy of Capital Cities or Katharine Graham of The Washington Post comes from their ability to make tough, rational decisions that favored long-term value over short-term applause. The second tenet is candor in communication with shareholders. Buffett despises corporate spin and glossy reports filled with empty optimism. He values honesty above all, especially when things go wrong. Managers who acknowledge mistakes openly demonstrate the confidence and integrity he admires. In contrast, those who hide poor results behind accounting gimmicks or vague explanations lose his trust immediately. Buffett's own annual letters to Berkshire Hathaway shareholders set the standard for transparency. They are written in plain English, explain both successes and failures, and treat investors as true partners. He believes that shareholders deserve to be informed as if they owned the entire business, because, in essence, they do. The best managers, he says, communicate with the same openness they would use if speaking to a family member who had all their savings invested in the company. The third management tenet is resistance to institutional imperatives, the natural but dangerous tendency of corporate leaders to follow the crowd. In the corporate world, managers often imitate their competitors. If one company diversifies into new industries, others feel compelled to do the same. If one overpays for acquisitions, others rush to replicate it. Buffett calls this the institutional imperative, the inertia that drives managers to act contrary to logic simply because everyone else is doing it. The truly great managers resist this pressure. They base decisions on facts and rational analysis, not on fashion or peer behavior. Buffett himself has spent decades avoiding trends that dominate Wall Street, from technology bubbles to short-term trading frenzies. He prizes managers who have the courage to stand apart from the herd and the patience to let rational thinking prevail. Another crucial aspect of management evaluation for Buffett: integrity and alignment with shareholders. He seeks leaders who view themselves as stewards of shareholder capital, not as employees chasing bonuses. In his ideal company, management holds significant personal stakes in the business, ensuring their interests mirror those of the owners. He avoids firms where executives enrich themselves through excessive stock options, lavish perks, or manipulative accounting. Buffett has long emphasized that honesty is an expensive gift. Don't expect it from cheap people. He would rather invest in a business run by people with average intelligence and high integrity than one led by geniuses with questionable ethics. In his view, character cannot be fixed by policy. It must be present from the start. Buffett also admires managers who understand the boundaries of their knowledge. He values humility, the recognition that not every opportunity should be pursued. Great managers, like great investors, know when to say no. They concentrate resources where they have a durable advantage rather than spreading themselves thin. This ability to focus, combined with trustworthiness and rationality, allows a company to compound its value safely over time. These management tenets explain why Berkshire Hathaway has thrived under Buffett's decentralized model. He acquires companies run by outstanding managers and gives them full autonomy. They operate independently, free from bureaucracy, yet always guided by Berkshire's shared philosophy of integrity and long-term value creation. Buffett does not micromanage because he chooses managers he can trust completely, and once trust is given, it is rarely revoked. Ultimately, Buffett's view of management reflects his belief that investing is a partnership built on mutual respect. Numbers can tell you what a company has done, but only people can determine what it will become. A great business with poor management will eventually falter, while a good business with honest, rational leaders can flourish for generations. Through his management tenets, Buffett teaches that success in investing is not just about analyzing data. It is about recognizing character, valuing integrity, and trusting only those whose principles align with your own.
Chapter 7. Investing Guidelines, Financial Tenets. In Warren Buffett's investment philosophy, understanding a company's financial strength is not about decoding complex formulas or memorizing ratios. It's about grasping the simple economic reality behind the numbers. Buffett is not a technician obsessed with short-term metrics. He is a business analyst who reads financial statements as a story about how effectively a company turns capital into profit. The financial tenets form the third cornerstone of his decision-making framework, following the business and management tenets. Through them, Buffett seeks to answer one essential question: is this company financially sound, and does it consistently generate high returns on capital without excessive risk? His focus on long-term profitability, conservative financing, and shareholder value separates him from the crowd of investors chasing quick gains. The first financial tenet is focus on return on equity, ROE, rather than earnings per share, EPS. Buffett believes that EPS can be manipulated or inflated through accounting tricks, acquisitions, or share buybacks. What truly matters is how efficiently management uses shareholders' money to generate profits. ROE reveals this efficiency. A company with high and consistent ROE demonstrates that it can earn strong profits without needing constant infusions of new capital. For Buffett, this measure captures the essence of good business performance, the ability to turn $1 of shareholder equity into more than $1 of value. He prefers companies whose ROE outpaces their peers year after year, not through leverage, but through genuine operational excellence. The second financial tenet is careful use of debt. Buffett has an almost allergic reaction to excessive borrowing. He knows that debt can magnify returns during good times, but can destroy even great companies during downturns. He wants businesses that earn money through skill and efficiency, not through financial engineering. His rule is simple: avoid companies that depend on debt to survive. Those that can finance growth internally through retained earnings are far more resilient. Buffett often points out that a business earning 15% on equity with little debt is far safer than one earning 20% on equity but relying heavily on borrowed funds. The key is sustainability. When a company's profits rely on borrowed money, its future rests on the kindness of bankers and the stability of interest rates, factors that no investor can control. Buffett prefers independence over fragility. The third financial tenet is high profit margins and consistent returns on assets. Buffett admires companies that convert revenue into profit efficiently and maintain that performance over time. Wide profit margins indicate that a business has pricing power, operational discipline, or both, qualities of a strong economic moat. Companies like Coca-Cola, with a globally recognized brand, can sell their products at premium prices and still retain loyal customers. Consistency in margins is equally important. Temporary spikes in profitability may signal luck or one-time events, while steady results over decades reflect an enduring advantage. Buffett studies historical financial data not to predict the next quarter, but to understand the company's long-term earning power, the capacity to grow value regardless of market cycles. Another essential financial tenet is the relationship between earnings and retained earnings. Buffett carefully examines how a company uses its profits. Retained earnings, but portion of profit not paid out as dividends, should create incremental value for shareholders. If management reinvests those funds intelligently, the company's intrinsic value should rise over time. However, if retained earnings are wasted on poor acquisitions or vanity projects, they destroy value. Buffett compares a company's retained earnings over a decade with the increase in its market value during the same period. If the latter does not exceed the former, management is not using capital effectively. This long-term perspective reflects Buffett's deep belief in the compounding power of capital when allocated wisely. The final financial tenet is soundness and transparency of accounting. Buffett insists on clean, conservative financial reporting. He wants earnings that reflect real economic performance, not accounting illusions. He avoids companies that rely on aggressive assumptions, inflated goodwill, or hidden liabilities. He trusts businesses that understate their profits rather than exaggerate them. Buffett's preference for simplicity extends here as well. If he cannot easily understand a company's financial statements, he simply walks away. In his view, opacity often hides risk, and clarity is the true mark of quality. What makes Buffett's financial analysis different from that of most investors is his patience. He does not rush to act on quarterly reports or market rumors. He uses financial data to measure a company's long-term compounding ability, not its short-term volatility. The numbers to him are only the reflection of deeper truths: managerial discipline, business stability, and economic strength. When he finds a company with consistently high returns on equity, low debt, durable margins, and honest accounting, he knows he has discovered a financial fortress capable of weathering any storm. Through these financial tenets, Buffett proves that great investing is not about complexity, it is clarity. The best businesses make money predictably and manage it wisely. They do not rely on borrowed funds or accounting magic. They build value steadily through sound operations and prudent capital allocation. For Buffett, financial statements are not a puzzle to solve, but a mirror reflecting the company's true character. And as with people, he invests only in those whose character he deeply understands and fully trusts.
Chapter 8. Investing Guidelines, Value Tenets. Warren Buffett's philosophy reaches its full expression in the value tenets, the final and perhaps most crucial part of his investment framework. After understanding a company's business, assessing its management, and evaluating its financial health, Buffett's final step is to determine what that business is worth. For him, investing is not about speculation or timing the market. It is about buying a piece of a business for less than its intrinsic value, and then patiently waiting for that value to be realized. In this chapter, Buffett's deep respect for logic, discipline, and simplicity comes into focus, as he explains how value, properly understood, becomes the anchor that keeps an investor steady amid the constant noise of the market. The foundation of Buffett's value tenets lies in a timeless principle learned from his mentor, Benjamin Graham: the distinction between price and value. The market, Buffett says, is a voting machine in the short term, but a weighing machine in the long term. Prices fluctuate daily according to emotion, fashion, and fear, but value is governed by the underlying economics of the business. Buffett refuses to let market moods dictate his judgment. Instead, he asks a simple but powerful question: what would this entire business be worth if the stock market closed for 10 years? This mindset transforms investing from a guessing game into a rational process of appraisal. The first value tenet is determining intrinsic value. Buffett defines intrinsic value as the present value of all future cash flows that a business will generate over its lifetime, discounted back to today at an appropriate rate. It is not a precise number, but a range based on reason and analysis. To calculate it, Buffett looks at how much cash a company can produce for its owners, not just how much accounting profit it reports. He then discounts that stream of cash using a conservative rate, typically tied to long-term government bonds, to ensure a margin of safety. This approach allows him to focus on the real economics of the business rather than market speculation. As he often reminds investors, value is what you get, price is what you pay. The second value tenet is the margin of safety. Even the most careful calculation of intrinsic value carries uncertainty. Future profits may fall, industries may change, or management may falter. To protect against these risks, Buffett insists on buying only when the stock price is significantly below the business's intrinsic value. This gap, the margin of safety, is the investor's shield against error and volatility. It ensures that even if the future turns out worse than expected, the investor still achieves an adequate return. Buffett learned this lesson early from Graham, but he expanded it by applying it not only to undervalued cigar butt stocks as Graham did, but also to high-quality businesses purchased at fair prices. The combination of quality and safety gives Buffett's strategy its enduring strength. The third value tenet is patience and long-term perspective. Buffett knows that markets often take time to recognize a company's true worth. He is content to wait years, even decades, for value to surface. This patience is not passive, it is rooted in confidence. Once Buffett buys a business, he sees himself as a partner in it, not a trader in its stock. He ignores daily price swings and focuses instead on the company's ability to grow intrinsic value through earnings and reinvestment. In a world obsessed with quarterly results, Buffett's time horizon gives him a distinct advantage. He plays what he calls the long game, knowing that compounding works its magic only for those who give it time. Another crucial element of Buffett's value philosophy is discipline. He never compromises on his principles, no matter how tempting the market may appear. When he cannot find a company that meets his criteria at a reasonable price, he simply does nothing. Holding cash, he says, is far better than owning mediocre assets. This willingness to wait separates him from the average investor, who feels compelled to act constantly. Buffett likens investing to baseball without called strikes. You can stand at the plate indefinitely until the perfect pitch comes along. When it does, you swing hard and decisively. Underlying all the value tenets is Buffett's belief that investing is as much a test of character as it is of intellect. It requires independence of thought, emotional stability, and humility before uncertainty. Buffett's success stems not from predicting the future, but from valuing the present correctly and buying with courage when others are fearful. By anchoring his decisions in intrinsic value and margin of safety, he turns market chaos into opportunity. In the end, Buffett's value tenets complete the circle of his philosophy. The business tenets tell him what to buy, the management tenets tell him who to trust, the financial tenets tell him how strong the company is, and the value tenets tell him what to pay. When all these align, Buffett acts boldly but rationally, often in defiance of popular opinion. His record proves that wealth in investing does not come from complexity or speed. It comes from clarity, patience, and discipline. Through the value tenets, Warren Buffett reminds us that the essence of great investing is simple. Buy wonderful businesses at sensible prices, hold them for the long run, and let time and compounding do the rest.
Chapter 9. Investing in Fixed Income Securities. While Warren Buffett is best known for his extraordinary success in the stock market, his approach to fixed income investments, bonds, preferred shares, and other debt instruments reveals another dimension of his disciplined thinking. Buffett views all investments, regardless of type, through the same lens, the relationship between price and intrinsic value. Bonds may seem dull compared to equities, but for Buffett, they represent a critical tool for preserving capital, managing risk, and maintaining flexibility. In this chapter, we explore how Buffett applies his timeless investment principles to fixed income securities and why he believes understanding them is essential for every intelligent investor. Buffett began his career in the 1950s as a pure Graham-style investor, hunting for bargains wherever he could find them. In those early years, he often bought deeply discounted bonds, known as workouts or arbitrage opportunities, where he could safely earn steady returns independent of market fluctuations. These situations appeal to his mathematical nature. A bond, after all, offers clarity. It pays a fixed interest rate and matures at a set value. By buying bonds below par value and holding them until redemption, Buffett could lock in predictable profits. This strategy served him well during periods of market uncertainty, allowing him to earn solid returns while others speculated on volatile stocks. However, as Buffett's thinking evolved, he recognized that most fixed income investments offered limited long-term potential. The reason lies in their very structure. A bond's upside is capped by its coupon rate, while its downside, the risk of default or inflation, is often underestimated. Unlike a great business that can compound earnings indefinitely, a bond simply pays interest and returns principal. Buffett began to see that over long periods, equities, not bonds, were the true wealth builders. Yet he never dismissed fixed income entirely. Instead, he treated it as a defensive weapon, something to deploy when equity markets offered few attractive opportunities or when macroeconomic conditions demanded caution. One of Buffett's key insights is that bonds are not inherently safe just because they are called fixed income. Safety depends entirely on the borrower's ability to pay and on the purchasing power of the money being repaid. During times of high inflation, even government bonds can become dangerous, as they guarantee a return in nominal terms but not in real value.
Buffett often warns investors that inflation is the silent tax on bondholders. A bond yielding 5% may appear stable, but if inflation runs at 6%, the investor is losing money in real terms. For this reason, Buffett rarely holds long-term bonds when inflation expectations are high. He prefers short-term instruments or cash equivalents that preserve flexibility and minimize exposure to changing interest rates. Despite his general preference for equities, Buffett occasionally finds exceptional opportunities in fixed income, usually when the market misprices risk. In the early 1980s, for instance, when interest rates soared above 15%, Buffett bought long-term treasury bonds, recognizing that such yields offered extraordinary real returns once inflation subsided. Similarly, he has purchased corporate and junk bonds when fear drove prices far below intrinsic value. In these cases, his approach mirrored his equity philosophy: buy when others are fearful and only when there is a wide margin of safety. Buffett's purchases of high-yield bonds during times of crisis, such as the early 2000s recession, were guided by the same logic that drives all his decisions: rational analysis, not emotion. Another important lesson from Buffett's approach to fixed income investing is his emphasis on opportunity cost. He always compares the expected return from a bond to what he could earn elsewhere, particularly in high-quality stocks. If the equity of a great business offers a higher long-term return with acceptable risk, he will favor it over any bond. Conversely, when the market becomes speculative and stock prices exceed intrinsic value, Buffett is content to hold bonds or cash until better opportunities appear. This flexibility, moving between asset classes without abandoning his core principles, demonstrates his mastery of capital allocation. Buffett also highlights the role of fixed income investments in Berkshire Hathaway's insurance operations. The company's insurance float must be invested conservatively, ensuring that claims can be paid regardless of market conditions. Here, Buffett uses bonds not for profit but for stability. He allocates a portion of the float to high-quality fixed-income securities to maintain liquidity, while the rest is invested in stocks for growth. This balance between safety and opportunity exemplifies his pragmatic approach: always secure the foundation before reaching for higher returns. In essence, Buffett's philosophy on fixed-income investing mirrors his broader worldview. He is not seduced by labels or conventions. He evaluates every asset class by its intrinsic economics. To him, bonds are neither good nor bad. They are tools, useful when employed with understanding and discipline. Their role is not to make you rich, but to preserve capital and provide flexibility when the world becomes uncertain. By treating fixed income as part of a unified framework of value investing, Buffett reminds us that the principles of rationality, patience, and margin of safety apply everywhere. Whether he is buying a government bond or a share of Coca-Cola, his goal never changes: to invest intelligently, protect against loss, and let time do the compounding.
Chapter 10. Managing your portfolio. For Warren Buffett, managing a portfolio is not about juggling dozens of stocks or reacting to every fluctuation in the market. It is about constructing a collection of businesses you truly understand and are willing to own for the long term. In this chapter, Buffett reveals that portfolio management, at its core, is not a science of prediction, but a discipline of patience, conviction, and focus. The successful investor's job is not to outguess the market, but to remain rational when others are not. His approach is guided by a few timeless principles: concentrate on quality, think independently, minimize turnover, and allow compounding to work its magic over time. Buffett begins with a principle that sets him apart from traditional diversification theory. He believes in focus, not dispersion. While most investors are taught to never put all their eggs in one basket, Buffett argues that diversification is protection against ignorance. It makes sense only for those who don't know what they're doing. For a knowledgeable investor, over-diversification dilutes conviction and reduces returns. He prefers to hold a small number of excellent businesses, each carefully chosen for its enduring economics and honest management. To Buffett, having 10 outstanding investments is far superior to owning 50 average ones. He manages Berkshire Hathaway's portfolio with this philosophy in mind. concentrating resources where the probability of long-term success is highest. The second key principle is long-term ownership. Buffett treats stocks as pieces of businesses, not as instruments for trading. Once he buys, he holds, sometimes for decades. He avoids the temptation of short-term gains, understanding that compounding requires time and consistency. He often says his favorite holding period is forever. This attitude frees him from the anxiety of market timing and from the emotional roller coaster that consumes most investors. Instead of predicting where the market will go next week, he focuses on whether the companies he owns will still be thriving 10 or 20 years from now. If the answer is yes, then temporary price swings are irrelevant. This patience transforms investing from speculation into partnership. Buffett's third principle is independence of thought. The market is a place where emotion often triumphs over logic. Crowds swing between greed and fear, and prices frequently reflect psychology more than reality. Buffett's success comes from his ability to detach from this emotional noise. He welcomes volatility, seeing it not as a threat but as an opportunity. When markets panic and prices fall, he buys. When euphoria drives prices above intrinsic value, he waits. His independence is not arrogance. It is grounded in his conviction that value always reasserts itself in the long run. He often paraphrases Ben Graham, "The market is there to serve you, not to instruct you." For Buffett, this means using market fluctuations to your advantage, not letting them dictate your behavior. Another essential component of Buffett's portfolio philosophy is minimal activity. He believes that constant buying and selling is the enemy of compounding. Every transaction incurs costs, commissions, taxes, and more subtly, the erosion of discipline. By holding investments for the long term, Buffett reduces friction and allows compounding to do the heavy lifting. He compares successful investing to growing a tree. You cannot make it grow faster by pulling on the branches. You must simply give it time, sunlight, and patience. This low turnover strategy not only increases returns, but also aligns with Buffett's temperament, steady, rational, and immune to market frenzy. Buffett also rejects the idea of trying to time the market. He admits that no one, not even the greatest investors, can consistently predict short-term movements. Instead, he advises focusing on time in the market rather than timing the market. The key is to buy wonderful businesses at fair prices and then let compounding do its work. Market corrections, recessions, and booms are inevitable, but they do not determine the fate of the disciplined investor. What matters is the underlying business performance. Over decades, earnings growth and intrinsic value, not market sentiment, drive investment success. A final, often overlooked principle in Buffett's approach is emotional control. He views temperament as more important than intelligence in investing. The ability to remain calm when others panic, to act decisively when opportunity arises, and to resist greed when markets are exuberant, these are the marks of a true investor. Buffett's famous saying captures it best: "Be fearful when others are greedy, and greedy when others are fearful." Portfolio management to him is not a game of superior information, but of superior temperament. In managing his portfolio, Buffett blends discipline with humility. He knows that mistakes are inevitable, but his framework minimizes their impact. By focusing on businesses with durable advantages, run by trustworthy people, purchased at sensible prices, and held patiently, he creates a portfolio that compounds value year after year. The simplicity of his approach hides its genius. Success comes not from doing more, but from doing less, carefully, intelligently, and consistently. In a world driven by noise, Buffett's portfolio philosophy stands as a quiet reminder that the greatest power in investing is not speed, complexity, or prediction. It is the calm conviction to own great businesses and let time do the rest.
Chapter 11: The Psychology of Money. Warren Buffett often reminds us that investing is not a test of intelligence, it is a test of temperament. In this chapter, The Psychology of Money, we explore one of the most powerful themes in Buffett's philosophy. Success in investing depends far more on mastering one's emotions than on mastering financial formulas.
Markets are not ruled by logic alone. They are governed by the collective emotions of millions of participants: fear, greed, envy, and pride. To succeed, an investor must learn to remain rational when others lose their composure, to think independently in the face of crowd behavior, and to make decisions rooted in facts rather than impulses. This psychological discipline is what separates Buffett from most investors, and it is the invisible advantage behind his extraordinary record. The first lesson Buffett teaches about money psychology is the importance of emotional stability. When prices rise rapidly, most people feel the urge to join the crowd. When prices fall, they panic and sell. Buffett does the opposite. He views market fluctuations as opportunities, not threats. In his eyes, volatility is the investor's friend because it allows him to buy great businesses at discounted prices. He has no interest in predicting short-term trends or reacting to market noise. Instead, he focuses on the long-term intrinsic value of companies. This emotional detachment, his ability to stay calm while others panic, comes from deep conviction and preparation. He knows exactly what he owns and why he owns it. Because of that, temporary losses never shake his confidence. The second principle is independence of thought. Buffett's greatest strength lies in his refusal to follow the herd. The stock market, he says, is a device for transferring money from the impatient to the patient. He understands that human beings crave validation and hate to stand alone, but in investing, independence is essential. Buffett has made some of his best decisions precisely when the crowd disagreed with him, buying American Express during its scandal in the 1960s, investing in the Washington Post when newspapers were out of favor, or purchasing stocks during the depths of the 2008 financial crisis. His secret is not contrarianism for its own sake, but rationality rooted in evidence. He acts based on logic, not emotion, and he's content to wait years before being proven right. In Buffett's world, courage means keeping your head when everyone else is losing theirs. The third insight in Buffett's psychology of money is the danger of greed and envy. Greed blinds investors to risk, while envy pushes them into comparisons that destroy focus and patience. Buffett has often said, "It's not greed that drives the world, but envy." Many investors fall into the trap of chasing returns because someone else seems to be making more. This endless comparison breeds reckless behavior, buying overvalued assets, speculating in bubbles, and ignoring fundamental analysis. Buffett's antidote is humility and self-discipline. He measures success not by beating others, but by achieving steady, rational growth in wealth. He is content to miss out on fads because he knows that compounding, though slow, is unstoppable over time. This mindset protects him from the emotional swings that ruin most investors. Another central theme in Buffett's psychological framework is patience and the power of inactivity. The modern market rewards action, traders who move fast, react instantly, and chase every opportunity. Buffett takes the opposite approach. He believes that doing nothing is often the hardest yet most profitable decision. He likens the stock market to a baseball game with no called strikes. You can watch pitch after pitch go by until the perfect one comes along. Most investors, he says, lose because they can't resist swinging at bad pitches. Patience, not speed, builds wealth. By waiting for the right business at the right price, Buffett ensures that every move he makes has a margin of safety built in. Finally, Buffett emphasizes self-awareness, knowing your own limits and controlling your impulses. The market constantly tempts investors to abandon logic for excitement. Buffett's lifelong success stems from his ability to stay within his circle of competence, to admit what he does not know, and to avoid mistakes that stem from overconfidence. He understands that rational behavior is rare because it requires humility. The greatest enemy of the investor, he often says, is not the market, it is himself. In essence, Buffett's psychology of money is a guide to mastering the mind before mastering the market. He teaches that intelligence without discipline is useless, that emotion without control is dangerous, and that wealth without patience is fleeting. His calm, measured approach reminds us that markets will always fluctuate, but human nature will not. Those who can control their emotions when others cannot will always have an advantage. Investing, in Buffett's world, is not about beating the market, it is about beating your own weaknesses. And once you can do that, success becomes not only possible, but inevitable.
Chapter 12. The Unreasonable Man. At the heart of Warren Buffett's extraordinary success lies a mindset that defies convention. In this final chapter, The Unreasonable Man, the author explores how Buffett's genius stems not from breaking rules, but from ignoring those that never made sense in the first place. George Bernard Shaw once wrote, "The reasonable man adapts himself to the world. The unreasonable one persists in trying to adapt the world to himself." Buffett is that unreasonable man. He refuses to conform to Wall Street's short-term obsessions, market fashions, or the emotional chaos that governs most investors. Instead, he builds his own framework, rational, patient, and entirely his own, and through it, achieves results that seem almost impossible in a world driven by impulse and imitation. Buffett's unreasonableness begins with his independence of thought. He has always questioned conventional wisdom. While most investors chase what's popular, he seeks what's neglected but valuable. When the crowd buys, he looks to sell. When the crowd panics, he calmly buys. His actions appear contrarian, but they are not driven by rebellion. They are grounded in reason. Buffett does not act differently to be different. He acts rationally when others are irrational. He understands that markets are ruled by emotion, and therefore the true edge lies in emotional control. To be an investor like Buffett, one must learn to think independently, resist peer pressure, and trust one's analysis even when it feels uncomfortable. His famous line captures this perfectly. "You can't do what everyone else is doing and expect to outperform." The second aspect of Buffett's unreasonableness is his long-term perspective. In an era obsessed with quarterly earnings, Buffett measures success in decades. He sees investing as a lifelong partnership with businesses, not as a series of short-term trades. When he buys a company, he does so with the mindset of a business owner, not a speculator. He avoids reacting to daily market swings because he knows value unfolds slowly, like compound interest. His patience is not passive, it is strategic. It allows him to act decisively when opportunities appear and to ignore distractions when they don't. Buffett's long-time horizon, combined with his unwavering discipline, creates a compounding effect that few investors can match. He once said, "Time is the friend of the wonderful business, the enemy of the mediocre." That belief has guided every major decision of his career. Another quality that defines Buffett as unreasonable is his focus on simplicity in a world that glorifies complexity. Wall Street thrives on intricate models, exotic derivatives, and constant innovation. Buffett thrives on common sense. He avoids businesses he doesn't understand, no matter how fashionable they are. He refuses to invest in companies that rely on unpredictable technologies or short-lived trends. Instead, he concentrates on stable, enduring industries, insurance, consumer goods, and services with predictable demand. His ability to simplify the complex is not ignorance, but mastery. Buffett knows that complexity often hides risk, while simplicity exposes truth. By staying within his circle of competence, he reduces mistakes and builds a foundation of reliability that compounds over time. Buffett's unreasonableness also extends to his moral philosophy. In a world that often confuses wealth with wisdom, Buffett's integrity stands out. He believes that reputation and trust are worth far more than any deal. He writes candidly to shareholders, admits mistakes openly, and avoids businesses that conflict with his values. He surrounds himself with people he respects and delegates authority to managers who share his ethical standards. His success is proof that decency and discipline are not obstacles to greatness, they are its foundation. Buffett's unreasonable refusal to compromise his principles has made him not just one of the richest men in history, but also one of the most respected. Finally, Buffett's unreasonableness lies in his faith in rational optimism. He believes deeply in the power of compounding, in human progress, and in the American economy. Even after market crashes, recessions, and panics, he never loses confidence in the long-term potential of business and innovation. His optimism is not naive, it is grounded in historical understanding. He sees volatility as opportunity, fear as mispricing, and patience as profit. This perspective allows him to remain calm in crises when others lose hope. For Buffett, reason and optimism are two sides of the same coin. They both require discipline, clarity, and courage. In the end, Buffett's success can be summed up in one truth: he is willing to be different. His unreasonable approach, thinking independently, acting patiently, and refusing to follow the crowd, has allowed him to achieve what few ever will. He proves that greatness in investing is not about speed, genius, or secret formulas, but about mastering oneself. The unreasonable man, in Buffett's world, is not the rebel who defies logic. It is the rational thinker who refuses to surrender it. By being calmly unreasonable in a world of constant noise, Warren Buffett has turned common sense into uncommon success and left behind a philosophy that will guide investors for generations to come.